gentlemen, this week's video, we are going to concentrate on my latest publication, which is not all REIT acquisitions have been beneficial to shareholders. Yes, ladies and gentlemen, this is the headline for our latest article, which you can view at GCP Global website, as well as the fact that if you look at the acquisitions in the last 5 years, despite Singapore REITs coming to the market to raise close to 26 billion and announcing close to 48 billion in terms of acquisitions, as you can see in my article, many have failed to deliver on their acquisition plans. So in today's video, we're going to discuss why and to what extent have many of these REIT managers been unable to deliver. Gentlemen, this is our latest article entitled, Not Many REIT Acquisitions Have Been Beneficial to Minority Shareholders. Now, mind you, ladies and gentlemen, we have tabulated all the acquisitions in the last 5 years from 2017, 2018, 2019, 2020, 2021. That's amounted to almost 48 billion. Now, the total funds raised, be it either preferential offer or private placement, is close to 26 billion. But you notice, ladies and gentlemen, if many of these REITs acquisitions that raise money at discounted prices to acquire assets have failed to deliver, what does it mean to you as a shareholder? It means only one thing, that is, capital has been destroyed. In our article, in our classes, we're going to explore with you why and to what extent capital have been destroyed. Now, remember, ladies and gentlemen, when you invest in REITs, there are two components of return. One is capital gain, or what they say, as well as dividend yield. If you are not getting the capital return, then why bother to even invest in these REITs? Alternatively, it also means that it may become a wake-up point for you to switch out of the bad REITs, supposedly, to the better REITs, the ones that can deliver on these two other components, that's capital return plus distribution returns. So if we move on to the next page, ladies and gentlemen, what we have noticed is that have the trend of S-REIT owning overseas assets, have they benefited minority shareholders? Now, you'll be surprised, ladies and gentlemen, as you run through, some of the REIT IPO in the last 5 years, from Keppel, KBS REIT, which is now known as Keppel Oat REIT, to Cromwell, to Cecil REIT, to ARA Hospitality, ladies and gentlemen, and even if you minus off the poorly debuted Eagle Hospitality, which has crashed. And guess what? Are the bankers being held accountable? Are the lawyers being held accountable? Are the advisors being held accountable? Well, you have the answer. So where do shareholders stand? Who protects your interests? So at GCP Global classes, we actually try to identify all these impediments, all these potential dangers way before they actually happen. So back to today, you can see that of the 8 remaining REITs that has listed in the last 5 years, practically only one, that's Lendlease Commercial, have assets that are predominantly in Singapore. The rest of them with predominantly assets or even 100% assets in the US, like Cromwell is in Europe, Cecil REIT is actually in China. You notice that only one, that Cecil REIT has its present share price as at the end of last month above its IPO price. The rest of them, you can see, ladies and gentlemen, yes, it's a wash in a sea of REIT. Now, for many of those, if you look at, say, Cromwell, Keppel Oat, Prime, United Hampshire, if you calculate even on a total return basis, that means including the dividends that they have paid you as a shareholder, minus off this capital loss, you will still be in a loss position. So what does it mean, therefore, to be investing in REITs when you're losing money? It's a losing proposition, isn't it? Right? So in my article, we have actually discussed this in detail, and more so, we are preempting that REITs will not really outperform because of rising interest rates based on past precedent, even though we are not totally negative, of REITs during the upward cycle is which stage of the interest rate upcycle will be the most present danger for REIT investors. That's what we discussed in our investment class. Now, we've talked about our investment class. The next class is actually on 7th of May. So as of today, you still have 2 more days to sign up based on a special early bird price. So do take your offer and sign up at this website. That is actually GCP Global website. If you're interested to know and protect and to prevent yourself from those REITs that will actually murder you in capital loss, not only just now, but in the future. So essentially, ladies and gentlemen, you notice that I was interviewed in the Business Times last month, and we have again propound and expound on the fact that too many REITs have been making cash calls that don't add value to unit holders. Now, ladies and gentlemen, this is a core topic that we've been warning for years, as in my book that is actually the Making Your Millions in REITs. So you can see therefore that the writing is clearly on the wall. Okay, so let's take one for example. So you may be very inquisitive right now. Why is it that REITs, despite its so-called status of risk adverse return, can still deliver negative returns? Let's just take Cromwell for example. So if you do recall, Cromwell is probably the second worst performer in the last 5 years among IPO debutants in the REIT market. Okay, so let's look at what essentially and why is it that Cromwell has not been able to deliver for its shareholders since its IPO. Now, Cromwell case typifies many of the foreign REITs that are listed in Singapore. So for example, Cromwell, when it's listed in 2017, it started with 74 assets. Many REITs are very proud that they can grow the number of assets over the years from 74 to, like in the case of Cromwell, from 74 to 112, right? This is based on their latest, as of 31st December 2021. In the process, the value of the assets increased from 1.35 billion euros to 2.44 billion euros. Meant, ladies and gentlemen, this sounds great. This sounds good for the REIT manager. But remember, what is good for the REIT manager and the sponsor may not be the case or automatically be the case for REIT shareholders. Let's look at how REIT shareholders of Cromwell have actually benefited or not benefited since IPO. As once again I highlighted in my book that is Making Your Millions in REITs, using Cromwell example. The Chinese equivalent of my book is actually published in China. You can buy it at any of the online stores, JD.com, Tangtang, so on and so forth. Cromwell is also highlighted. You can see that Cromwell debuted with an IPO price of 55 cents. It is one of the rare REITs, in fact, one of the first maybe, or in the S-REIT history of 20 years that consolidated 5 units into one. So theoretically speaking, therefore, their IPO price at 55 cents times 5 is 275. So if you draw a line on the IPO price, you will notice, ladies and gentlemen, in the course of this listing history, which now comes to 5 years, right? That means 2017, 2018, 2019, 2000, 2001, 2002. So actually, it is in its 6th year of listing. Now, only twice, like in this instance here and in this instance here, have they traded above its IPO price. And mind you, ladies and gentlemen, this is a daily chart, which shows that when Cromwell did go up above its IPO price, it was only for a couple of days during this period and during this period. So the rest of its 6 years, 5.5, 6 years, okay, you can see they were trading at way below its IPO price. So of course, being not a very strong REIT, among shareholders, you can see the stock price practically crashed by close to 50% during the pandemic sell-off from 19th of February 20 to 23rd of February, 23rd of March 2020. You notice, ladies and gentlemen, in GCB global classes, we always want you to stay out of the so-called weak REITs, because they are the ones that institutions, they are the ones that investors will sell off first at the first sign of trouble. Okay, so you can see this is what Cromwell has done, but fundamentally, how has the company done? So despite having and made so much acquisitions, and Cromwell's assertion that diversified funding sources underpin the balance sheet, but when you look at his latest set of results, one key number becomes very glaring, and that is, if you use the NAV, you notice that the NAV actually declined by 1.2%, right? So essentially, this means that one of the key metric in valuation of the REIT, because NAV, most analysts would use it as price to NAV as a benchmark to evaluate REITs. So if the NAV falls despite 5 years of undertaking acquisitions, as you saw earlier in the earlier slide, the number of acquisitions shot up from 1.35 to 2.44 billion. That's almost double in value. But when it comes to the NAV, what you're seeing is not even an increase of doubling, let alone 20% of the NAV, but a decrease. Then you look at its results. Now, despite the REIT saying that their results is resilient, what does it actually mean for investors? It means that the actual DPU paid to you as investor dropped last year, right? The year before, it was 17.42 cents. Last year, it was 16.96 cents, or a drop of 2.6%. So, ladies and gentlemen, how does one, as well as a concerted REIT investor, makes wise decision such that you will not be merged in this kind of REITs that will suffer capital loss, in the last 5 years, 6 years of its REIT history? Now, what lessons can you draw? How to avoid future Cromwells as well as future REITs with foreign assets that will put you in the rate as an investor? Okay, so now that's what we focus at in our GCB global classes. In fact, in our classes, as you can see from my Business Times interview, we focus a lot on return on invested capital as a key benchmark in evaluating REITs. We also use and supplement and complement it with EV/EBITDA valuation. How to calculate this? In fact, it is very clear that the methodology that we use is similar to, yes, none other than Mr. Warren Buffett. Okay, in his picking up stocks, you notice in his latest acquisitions, he bought into Alicante, the insurance company. He also took a stake into HP. Right? You'd be surprised that the ROC numbers for these companies are comparable, to the trends that we see as what we teach in our classes. So once again, if you enjoy our video, give us a thumbs up and subscribe if you our subscriber. Send us an email at gcbglobalsg@gmail.com. Stand a chance to win a prize, if we have more than 20 entries, where we'll draw a lucky prize winner at the end of the month. If not, do sign up for our special early bird prize for our next class on 7th of May, where we will be discussing in detail things like essentially what REITs to avoid, what REITs to have in your portfolio, so that you have a good sustainable run in your REIT assets. The key thing, ladies and gentlemen, is that when you are invested in the wrong REITs, being humans, psychologically you'll be drained in terms of your attention, in terms of your money, in terms of your happiness. So the whole idea in investing in REITs, ladies and gentlemen, is to be happy because you are getting consistent, steady returns from the DPU and not be merged into troubles when REITs go on acquisitions, and then you'll be worrying what kind of discount in terms of the prices that they are dealing or dishing out in terms of new shares or preferential offer. So of course, in our classes, we will guide you on this as well as to preempt and prepare you so that you would be not in a position where you have picked the wrong REITs. And you have picked the wrong REITs, we will guide you on how to actually transact out into the better REITs to have in your portfolio to have a long and great time. So 2 more days, do sign up for our classes to enjoy the early bird special. And happy Easter to everyone. The Lord has risen.